let's start the second part of this conference. Well, first of all, thanks Ramon for organizing the whole thing. For us, Banco de España, is a great pleasure to help with the whole thing. I mean, as for everybody else, this is a very important issue, but for Spain, it's indeed a critical matter, as the last one of the slides of Ellen McGrathans just put in a very blunt way. So to discuss on the policy implications around the problems of the public pension systems, and in particular to the pay-as-you-go systems, we are today in a very good company. I'm very happy and very honored to welcome the four panelists. With us is Pablo Antolín, who is a principal economist and head of the private pension unit at the OECD. Javier Díaz-Giménez, professor of economics at the IESE Business School. Esther Gordo, who is the director of economic analysis at AIReF, the Spanish Independent Authority for Fiscal Responsibility. And last but not least, Carolin Nerlich, senior economist at the European Central Bank. So in terms of putting some order on the interventions, I would suggest moving from the broader perspective of the OECD. So Pablo would give us some ideas of the reforms that have been undertaken by some OECD countries. Then we could move to the Euro area with Carolin's reflections, and then we may jump into the particular Spanish case with Esther's and Javier's points. But before giving the floor to Pablo, you, Ramon, wanted to make some brief remarks, right, Ramon?
Well, I think that we are short of time, so most of you were in the first part, and I think we got a good summary given the good discussions at the end of what was out of these papers. So I'm just going to skip mine, and let's get started. Okay, thank you, Ramon. So the idea is to have an initial brief intervention by each of the four panelists, and then we may open the floor for a wider discussion with the audience. So Pablo, please.
Thank you very much, Oscar. Thank you very much for giving me the opportunity, me and the OECD, to be here and express our point of view. I'm just going to present a few issues about the main messages that we have in the OECD with respect to the type of reforms that have been implemented in most OECD countries. Also, what are the main reforms on the pay-as-you-go and on the funded part. I don't know if some of you have noticed the difference between British funded and American funded, different things. The second thing I will be talking is I will focus more on funded pension system, how to improve the design of retirement saving arrangements. And also I have some slides about proposals of where Spain could go given the international experience on countries, but I will leave that for later. First, on the main message is most OECD countries have done important reforms in the retirement systems over the last decade or the last 2 decades. And Spain is one of the countries that probably have done the least, in particular on the funded part. All countries have reformed pay-as-you-go public pensions with the goal of making them financially sustainable. And one of the main ideas have been the introduction of automatic adjustments of the entitlements that DB pay-as-you-go public pensions mean for people, and to align them with the actual materialization of the different macro and demographic variables. But also, and most importantly, in the case of Spain, most OECD countries have either reinforced, have promoted or encouraged the expansion of funded arrangements. They have built retirement savings whether occupational or personal, but the key thing is that retirement income depends on contributions, returns on the investment of those contributions, and also on how the assets accumulated, earmarked for retirement, accumulated at the time of retirement, are allocated to obtain a stream of income thereafter, meaning during retirement. We also have argued, and this is very important given the experience of many countries, that any reform of a pension system requires a comprehensive or a holistic approach that takes into account the interaction between the different components of the pension system in a country. You need to reform the pay-as-you-go system. Some people might argue because they are generous, because they don't adjust automatically to the actual realization of the key parameters. But you also need to reform and to promote the accumulation of assets earmarked for retirement. The systems, the retirement system encompasses different arrangements, and they all need to be reformed together, because otherwise all the trade-offs and effects between the different systems might get distorted. And this later approach, or this later idea, is very important because it's what it makes Spain quite different with many countries. In Spain, most of the reform, if all, have been on the pay-as-you-go system, nothing on the funded approach. We get this question many times at the OECD of what is the best system, what is the best approach to reform. We always argue that there is no perfect or best approach. There are different choices that policymakers need to make, and each of those choices have implications and trade-off. And what is important for us is that when policymakers make a choice, make a decision, they are aware of the implications and the trade-offs that their choices imply. So this is our key messages. What are the main reforms? Well, as I say, they have reformed pay-as-you-go system, and they have reinforced or promoted funded assets accumulated to finance retirement. First, most countries have separated the sources to finance public pension, differentiating between contributory and non-contributory. We all know that this is not fully the case in Spain. There has been a parametric adjustments, which Spain have done a lot of them. For the typical one have been an increase in the entire career for the calculation of the pension benefits instead of the final salary or a determined number of years, like the best years of the last few years. They have increased the retirement age. The first steps were to increase the retirement age of women towards that of men and have the same retirement age, but later on was to increase it from 65 to 67, and also to actuarially adjust early retirement so that they are actuarially neutral. They have also introduced automatic adjustments on the entitlements of the pay-as-you-go system, as I say, to the actual materialization of the different macro and demographic variables. Some countries have introduced individual actuarial criteria, what is called in the literature national defined contributions, the Baltics, Italy, Poland, Sweden. Others have focused more on a macro actuarial criteria, like the sustainability factors and linking the statutory retirement age to improvements in life expectancy. This is the road that Spain took at one point in time. It doesn't seem that this is the case now at all. Also, a lot of countries have introduced independent institutions that provide reports on the financial sustainability of the system using actuarial criteria, like the Office of the Chief Actuary, the Conseil Economique, and AIReF, and I will have the pleasure later to hear the opinion of someone from the AIReF. The next issue, as I mentioned, has been the strengthening of funded systems. And this has always been based on the idea that it's important to diversify the sources to finance retirement by promoting and strengthening funded system to complement pay-as-you-go. It's not either or, it's both. They need to be designed together, they need to be complemented. And the strengthening of the regulatory framework requires, from our point of view, and this has been the approach taken by many countries, to look at how pension funds work, core principle of private pension regulation. And the key thing here is the best interest of members, people saving for retirement. And also important to improve the design of these pension plans. How to improve the design? That's the second message. Well, we talk about issues of coherence, inclusiveness, mandatory, voluntary, incentive, fees, and others like investment strategies and defaults that some of the papers before have been talking, but also the payout phase, mortality table, different approaches to risk sharing, and communication, information, and financial literacy. Some of the commentators before talk about financial literacy, and this is an important factor. So coherence, well, you need to design funded system and pay-as-you-go system together. You need to reform them together. Inclusiveness, this should be for all the citizens. In Spain, not everybody has access to pension plans, to plans de pensiones, and they seem to be quite good in comparison with other countries. Incentives, financial incentives are important. We have studies at the OECD. Spain doesn't have particularly high financial incentives when compared internationally. The regulatory framework with respect to fees and charges should make sure that fees that pension funds charge are in line with the cost of the services they provide. And there are tons of good examples in many OECD countries of how to do that. I will be happy to discuss later on that. Investment strategies, defaults, the payout phase, as I say, it's important to have good mortality tables that include improvement for life expectancy, and it is important to update them regularly. There are many ways of sharing risk, collective defined contributions, and that are being discussed in many countries, daunting type of approaches. And then communication, information, and financial literacy. All these things should be focused with clear goals and purpose. And one issue, one approach, it's important to evaluate all these approaches according to the goals. And many of these approaches to communication, to information, the goal is to elicit a proactive behavior from the part of individuals, like, for example, saving more and saving longer. But one key important is, it's not people that have to understand us. We have to explain, communicate in a way that we make ourselves understood. And finally, I know a lot of people talk in Spain about mandatory, compulsion, no compulsion, whether it should be auto-enrollment. Well, all of this depends on what is the policy goal. The countries that have a mandatory system and their policy goal is to have the highest coverage, examples, Australia and Netherlands, it works. Compulsion can be at the national level, like in Australia, or it can be through social partner bargaining, like in the Denmark or the Netherlands. Self-compulsion, like auto-enrollment, it's an excellent second best, and it works to achieve high coverage. And it works by using behavioral economics, inertia, somebody mentioned before. However, when one talks about automatic enrollment, and in the OECD, we support automatic enrollment, but we have learned many experiences from trying to understand how it works in different countries. It's mandatory for employers. It is costly for employers. It's voluntary for individuals. And you can achieve a lot of high coverage, but also because the employer is mandated to enroll everyone every X years, in the case in the UK, every 3 years. And also it's important to highlight that the UK system is an auto-enrolling system. It's not like sometimes people mention it's a NEST system. The UK has NEST. NEST is a public pension provider, and that has the obligation of taking any individual when employers, which has the obligation of choosing a pension plan, do not choose a provider. So in some sense, it's a sort of public default provider. And the role of the employer in the auto-enrollment system is essential. That is the UK approach, but there are other approaches about auto-enrollment. And of course, auto-enrollment means equal access, as I mentioned before, which is not the case of Spain. As I mentioned, los planes de pensiones are quite great in Spain, but they are for a privileged few. And planes personales are very expensive, and some people might argue that are badly managed. Later on, if questions come, I will be happy to talk about proposals to the Spanish system. Thank you.
Great, thank you, Pablo, for also for adjusting to the brief time slot. So next, Carolin, please. I guess you wanted to use some slides, right?
Yes, hello. So can you see my screen?
Yes, it's not in full screen, but yes, we can. I think we can follow as it is right now. Yeah.
Okay, let me try. Okay, so hopefully now it's in full screen. Yes, so thank you very much for inviting me to this very interesting conference and for being able to participate in this policy panel. So, I mean, I will focus in my intervention mainly from a Euro area perspective and take a bit
Sorry,
of
Dr.
a
Nerlich,
broader...
we don't see your slides now. We just see your desktop. Maybe you should either switch your screen or keep the slides in PowerPoint without going in full screen, unfortunately.
Oh, I'm sorry. Let me see. So maybe then I stick to, do you see my slides now in small?
Yes.
Okay, so sorry for this inconvenience. So then I will stick to the way I, okay, so as I said, I will take a bit of a broader picture given, I mean, also underlying why this is also relevant from a Euro area perspective. So let me start now with, I mean, the challenges of population aging in the Euro area are tremendous, also compared to other countries. Like we heard a lot about the US. So obviously in many Euro area countries, the challenges are more, I mean, more severe. And so they imply also very large effects for the economy, but also for fiscal public finances, but also financial markets. So I mean, to look at potential growth, I mean, everybody knows that in an aging society, there will be with some over time a decline in labor supply. There's also great research, even by Banco de España, showing that there is a decline in productivity as countries start to age. Then, I mean, we already heard a lot about the implications of population aging for the pension systems and public pension expenditures. This can cause at some point also, of course, challenges for debt sustainability. There are also more subtle implications through impacts on the automatic stabilizers or also fiscal multipliers due to population aging. Then, of course, I mean, there are also the effects of population aging with respect to the natural rate of interest. Here, there is a broad range of literature that shows different channels through which population aging is likely to have a negative or I mean a declining impact, further declining impact on the natural rate of interest, and this is of course causing also challenges for monetary policy, in particular if monetary policy is at the effective lower bound. Then also population aging is posing some challenges or is also imposing changes in financial systems. So there is, I mean, if one assumes that older generations are more risk averse, I mean, this is likely to affect the structure asset holdings, credit growth is likely to decline, and several of these, there are several effects that one can detect. All of this, against this background, it's likely that macroeconomic stabilization is likely to become more complicated with population aging. So one can expect that macroeconomic volatility is likely to increase compared to what we have experienced so far. So it is an important issue also from a monetary policy perspective. And to safeguard against these implications, then there is certainly a need to implement more forcefully structural reforms, namely pension reforms, but also reforms that are complemented on the labor market side, in particular to support labor market participation of older workers. So what have we done so far in Europe with respect to pension reform? So we already had a very nice overview by Pablo on this, so I can be very brief here. You see on the slides here the changes in the statutory retirement age over the last 20 years. So there have been major reforms in the euro area, in particular after the financial crisis in a number of countries, and they have affected various aspects. So and as also mentioned by Pablo, that was mainly with respect to the pay-as-you-go systems and less for the fully funded system. And concentrating here on changes in the retirement age for men and women, you see that the blue bars are the situation in 2000, and the yellow and orange dots show the change by 2010 and 2019. So there have been in basically all countries an increase in the retirement age. Also, the early retirement schemes have been adjusted quite forcefully. And so this is likely then to have also contributed to contain the projected dynamics of public pension schemes over the years. And if one looks indeed at the labor force participation rate over the same horizon, so from 2000 until basically now, indeed there is a huge improvement in the labor force participation rate, in particular for older cohorts, and so there's likely to be an important impact coming from pension reforms. And this improvement you see with the orange bars, both for men and even more for women. And you can also see then the alignment between the retirement age of women and men, that this also is likely to have an impact on the improvement in the labor force participation rate, which help to counterbalance the adverse impact coming from population aging on labor supply. So the question is whether this is sufficient. Whether all these reforms are sufficient, and this is certainly not the case. And we heard many. The research shown. Also highlighted the need to do more and to go even much beyond just reforming the pay-as-you-go system. What I wanted to show here, but I will be very brief, is some simulations where we use a general equilibrium model with an OLG structure, and this is calibrated to several countries, including Spain, where we showed to what extent, which I mean, staying in the family of the pay-as-you-go system, which policy instrument need to be adjusted by how much in order to keep the public debt to GDP level at its current level. And we use data from the 2018 aging report, and in order to try to mimic their pension projections, and keeping all policy instruments constant, public debt would increase by 140% of GDP by 2070. And in order to address this, one would need to have quite substantial policy reforms. For example, an increase in the retirement age by 3.5 years compared to today by 2070. So just to give an illustration in terms of the dimension that would be required in order to bring or to keep the debt dynamics under control. And one important point that I would like to highlight here, also with respect to the whole discussion, is that it's not only that we have a funding gap or a challenge to ensure the sustainability of the pension systems, but it's also that in addition to that, there is a risk that that some of these reforms that have been adopted in the past 20 years are reversed. So there are a number of countries where we can already observe that, and that also relates both to pay-as-you-go systems as well as to fully funded systems. I mean, there are several examples in the Eastern European countries for that, and with the same model in the same paper that I showed before, I mean, with my two co-authors from the IMF, we did such an exercise where we plugged in some reform reversals here for Germany and Slovakia, and tried to show to what extent these reform reversals lead to an even higher increase in the debt to GDP ratio, which in the case of Germany, where they put a threshold both for the decline in the benefit ratio and the increase in the contribution rate by 2025, and which we assume to increase to 2040, that this would imply an increase in the debt to GDP ratio by almost 60% of GDP, in addition to what is already expected without any policy change. In Slovakia, where they abandoned the automatic link between life expectancy and increase in retirement, this reform reversal would result in an increase by 50 percentage points of debt to GDP. So this is certainly going in the wrong direction. And this brings me then to my last point. So the main challenges ahead here, I mean, it's clear that further pension reforms are needed. So both within the pay-as-you-go systems, but also to enlarge possibly also towards fully funded schemes. But that is likely to be very country specific. And the path which needs to be, which would be best for each country to take. But even, I mean, also very crucial from our perspective is to avoid that countries implement or go in the direction of reform reversals. So this should be clearly, I mean, there should be a clear signal that this is going in the wrong direction. Then also there is the window of opportunity to change pension systems is certainly, or to have an impact by changing the social security systems is kind of shrinking, in the sense that the baby booms generation, which is already starting to get retired and which is likely to be fully retired by 2035 in the euro area, I mean, this is putting some pressure, I mean, to act rather sooner than later. And of course, there's also the political economy argument that, of course, with an aging of the voter, the likelihood that major reforms of the pension systems will go through is gradually shrinking. In particular, if this would affect the older workers. And finally, certainly the COVID crisis has limited the fiscal room for maneuver even further, which makes it even more important to go ahead with reforming the pension systems to make them more sustainable. So I leave it here. Sorry if I was a bit on the long side.
Thank you very much, Carolin. So for those of you who are not that familiar with these matters, let me just be clear on the fact that Spain is certainly within the group of European countries that has already undone some important reforms that were adopted after the global financial crisis, I think, which is posing a lot of extra pressure on the public pension system. Maybe Esther or Javier later on will say something on this. So Esther, please, the floor is yours.
Okay, thank you very much, Ramon, and thank you very much, Oscar, for inviting me to this very interesting conference. Well, as you know, AIReF has the responsibility to analyze the sustainability of our social security system. And in order to meet that mandate, we have developed and designed a complete set of models to forecast pension spending, but also to forecast project its main determinants, demographics, the labor market behavior, and also to assess the impact of projected and planned and past reforms. The past year, by fall last year, we published a report updating our results and considering to some extent the impact of the COVID crisis. We corrected to some extent mortality and also immigration flows, but for the time being, we haven't taken into account any effect on fertility that we think is going to be sure. And in this intervention, I try to give you, to summarize you the main results of our analysis, because I think it's important to assess the challenge we are facing and also the need to, the extent of the magnitude of the reforms that we need to implement. Well, as a summary, our projections, our central scenario, which include the impact of the parametric reforms that we approved in the year 2011, and also the sustainability factor we assume is going to be enforced as from 2023. Including these reforms, our projections suggest that pension spending will increase by more than 3 percentage points in the following decades, increasing to above 14% of GDP as a share of GDP in 2050. This figure may not seem excessive, but as Carolin has mentioned, it's important to put it in terms of what is the implication for debt. And we have calculated that it implies an increase of 60 percentage points of debt, a higher debt ratio of 60 percentage points, in 2050, which is a significant amount for a country that is going to see the crisis with a debt ratio higher than 100. But in any case, looking at these numbers, one may conclude that perhaps the parametric reforms are going to be sufficient to cope with increasing pension spending. And indeed, when we do that analysis, when we assume that a deepening in the parametric reforms, and particularly an increase in the effective age of retirement by 2 years, and also we assume an increase in the number of years considering to calculate the pension from the current 25 to 35. When we assume these reforms, we see that pension spending, the increase in pension spending that we estimated before could be offset by 1.4 percentage points. Sorry, for me it's very difficult to say that. I don't know why. But in any case, despite these parametric reforms, the to GDP ratio will increase by 40 percentage points. And more importantly, we think that there is a lot of uncertainty surrounding these pension projections. In the case of demographic, we don't have any doubt. The challenge is there. The tsunami that Ellen was mentioning is there. And we have analyzed different reports, and almost all existing projections suggest that the old age dependency ratio will increase above 50% by 2050. So for every person retired, we will have less than 2 people working in working age. So this is a very big challenge, On the positive side, we have that this reflects an increase in longevity. We are champions in longevity, so nothing to say that. But on the negative side, it's the result of one of the lowest fertility rates among the developed countries. We are close to 1 child per woman. This is very low, and we think this is not just a transitory phenomenon. It has been with us for more than 3 decades, and we think it's closely related to the precarious situation of our young population in the labor market. So we think that, as Carolin has mentioned, we think that if we want to make our pension system more robust, why don't we start by solving the structural problems in our labor market, and particularly those affecting the young people? We think this is a crucial step. Well, our models also project a range of immigration, which is on the upper range of the available estimates. But in any case, we think it's not going to be sufficient to compensate for the low fertility rate, for 30 years of very low fertility rates. So the demographic challenge is clear. And the question is, to what extent the long-term growth or the behavior of the labor market or productivity increase are going to be able to compensate for this challenge. In this area, we see significant risk, and we see that in general, most of the AIReF ones amongst them, most of the studies tend to rely on a rather optimistic labor market behavior. Most of them tend to assume that the unemployment rate converts in the long term to an international average, which in our case is close to 7%, which is a very challenging assumption for an economy, for the Spanish economy. And also in the case of productivity, we see that most of the studies rely on the assumption that it's going to convert to its historical average, which is also a challenging assumption, especially if we take into account the impact of aging. So as the Banco de España studies have shown. So taking into account all these results, what we can conclude of our analysis is that first, even under optimistic macroeconomic scenarios, pension spending will increase by 3 or 2 or 4 percentage points, which is a significant amount in terms of debt. 3 percentage points accumulated over time means 60% points more of debt. And of course, more adverse scenarios may materialize. So also, we think it makes sense to continue deepening parametric reforms. We think it's reasonable. At the same time, we need to be prepared for the worst, for the worst case scenario, and we think that further reforms need to be explored because it takes a lot of time to get the political consensus to approve any reform. And I think it's not easy, as Pablo has mentioned, whichever the solution, it needs to be it needs to be holistic. It needs to strike a balance between sustainability, sufficiency, intergenerational fairness, and it must be politically feasible. And of course, recently we have seen the reversal. We have had an experience with the reversal of some reforms that, I'm referring to the pension revaluation index that entailed a significant cut in the pension benefit. At the end, it failed to find the political consensus. So it is not an easy task. But we need to as I mentioned, we need to be prepared for the worst. And in terms of specific reforms, what's our position? Well, we think that it seems reasonable to delay further the effective retirement age. Within it, there is more room to come closer to the legal age of retirement, and is fully justified by the increase in life expectancy. Increasing the number of years taking into account to calculate the regulatory base is true that it could bring the Spanish system closer in line with the situation of other European countries, but we need to take it into account that it entails a cut in the pension benefit. And I think that what is more important, we need to analyze the impact of this measure on workers with shorter careers and frequent periods of unemployment. And I think that the heterogeneity, we have been talking about a lot of heterogeneity, but we need that in the case of Spain, we need to take into account the heterogeneity of our labor market to design any specific reform. On the sustainability factor, well, we think that perhaps the past proposal, the proposal that is current on the table, not the current one, the past one is not the best in terms of transparency, but well, in any case, we need to find is very reasonable establishing a link between the size of the pension benefit or the retirement age and life expectancy is a way to adapt to the new concept of old. We see, and finally, we see also scope for reflecting on the role of supplementary private saving mechanism. As you know, AIReF has published recently a report analyzing the incentives associated to this instrument, and we find that the profitability of the instrument is practically nil, practically zero once we consider future taxes and also commissions. The incentives tend to be somewhat regressive, and what is more important, we find that they have failed to meet the final target to increase private savings. So perhaps there is a need to redesign these incentives in order for them to be effective. I'm leaving there. Thank you.
Thank you very much, Esther, for this very clear and detailed exposition, and very realistic, by the way. So thank you very much. Javier, you are our last hope for bringing some optimism on the table. So please. Do I know you are not very optimistic? We cannot hear you. Javier? We cannot hear you. Are you muted? Now?
hope you can hear me.
Yes, now yes, please.
Okay.
Good.
All right. I'm sorry. I have a great microphone that's not working. Okay, so what can I do?
Yeah.
Anyway, so you were
Great.
telling me that I'm supposed to give you some optimism, and I was going to call this the good, the bad, and the ugly, but then I couldn't think of any good, so it's just the bad and the ugly. Maybe the optimism comes from the ugly. All right. So I'm just going to, I agree with almost everything you guys said. So and you all made very good points. I'm going to try to mention a few of the things that you, given that I'm the last speaker, that you have not mentioned, and so I'm just going to briefly discuss some of the problems and what I think are the main solutions. I will be making some sweeping statements. Some of them are, I can write a paper. I mean, I have proved them in papers in the past. I've written with Julián Díaz-Saavedra. Some are just hunches after having been working on pensions, and more specifically on Spanish pension system for the last 20 years or so. So the first thing that we have been saying, and that is absolutely true, is that the Spanish demographics have completely overwhelmed the pay-as-you-go pension system. Okay, and this is the result of three very negative factors: the baby boom between 1960 and 1975, a baby bust shared by other Southern European countries like France and Italy after 1975. But the thing is that Spain, together with Italy, but Spain a little bit more radical, never recovered from the baby bust, and we are in 1.3 children per woman, and then of course we're champions in life expectancy together with the Italians. So that really overwhelms any pay-as-you-go pension system, and there's very little you can do about that, certainly in the short term. Okay, so let me be optimistic. So this lasts until the people born in between 1960 and 1970s die. So we have a problem with Spanish pensions for about 40 years or so, but then it's over. Okay, so magical solutions will solve everything in 40 years time. Okay, I don't know how much Spanish debt will the ECB, Carolin, will have by then, and probably 3 or 4 times GDP. But you guys are going to buy it anyway, so who cares? Okay, so that's the first thing. The second thing is that the result of this is that the Spanish pension entitlement cannot be paid by current or future tax collections, payroll tax collections. This year, the pension deficit was 20 billion. But this is only because another 30 billion were paid into the system from general government funds. So it was 50 billion. In fact, not all of that is pensions, because the first reform, the first solution would be Spain has a traditional 19th century social security system where pensions are lumped together with unemployment insurance, and so the first thing I would recommend is that we get a pension agency in a country where everybody and their sister have agencies. Why is there not a pension agency separated from everything else? Because designing sustainable pensions is very, very, very easy from a technical point of view, even in Spain and even with our demographics. So it cannot be paid with current payroll tax collections, and as Esther has mentioned, payroll pension expenditures will just increase in every scenario between 3 and 5, maybe even more points of GDP. The next thing that you have not mentioned is what you kind of have brushed on is the political sustainability of our pension system, and it so happens that the elderly has captured it. In the median voter in Spain, the current age of the median voter is 50.1. So that means that in Spain we only have 2 political parties, the over 50s and the under 50s. We always win the elections. Okay, so if you are less than 50 in Spain, well, too bad for you. Just get old, grow old, because you have nothing to. There's no way you can touch our pensions. Okay, and in fact, so how come you guys have 4 national parties? Well, because we have a sinister institution called Pacto de Toledo, which says let's not discuss pensions politically, so we can have 4 parties instead of 2. Okay, so that's how we keep this thing under the rug, and nobody except for a few brave few discusses pensions openly in the terms I do in Spain. So the pension system is captured. When we have tried parametric reforms that cut pensions or delayed effective retirement ages, they have never worked. The elderly have taken the streets, we have taken the streets, and we have said, no way, you guys are not going to touch our pensions. And of course, all these reforms, as somebody mentioned, have been rolled back, and that's the end of that. Pensions will be paid in Spain, and they will be updated with the CPI. End of the story. Okay, and if anybody wants to bet, I'm happy to take any and all of your bets. Okay, it's not going to happen. Okay, so to make matters worse, there's two extra features of Spanish pension system. One is that Spanish pensions are extremely generous relative to contributions, which is how you should measure generosity of pensions. Okay, and we are always, in the top 2 or top 3 OECD countries when you calculate the pension replacement rates. And finally, to make matters worse, retirement income, because pensions are so generous, comes in Spain almost exclusively from this defined contribution pay-as-you-go pension system. We are at the bottom of the OECD tables in funded pensions of any kind, either personal pension plans or employment pension plans. There's no funded anything in Spain in any kind of quantitative, significant, or substantial way. So all this generates a public. We have an intergenerational pact that nobody believes in, and Spaniards think we're not going to get pensions, but they don't seem to care. I mean, they don't do anything about it. But basically, that's what happens. On the reform side, we know that parametric reforms and magical solutions, which and cheating with the accounting, like moving items from one side of the budget to the other budget, that's not going to do anything. Okay, we have this accounting fiction in Spain that we have 2 budgets, that the Social Security has a budget and the general government has another budget, but it's obviously it's a pure fiction. There's only one, and shifting things around doesn't change anything at all. Okay, so that's not going to work. So what could work? Okay, what could work? Well, before I say what could work, let me insist on something that has been mentioned. Reforming pensions does not solve labor market problems, and reforming labor markets does not solve the problems of education. Okay, because the pension system inherits the problems of the labor market inherits the problems of the education system. You want to start getting things straightened up, start with education. That's the only thing you can start with. Once you do that, reform labor market. Once you do that, reform pensions. Okay, so yes, it has to be holistic, but much more than you guys were mentioning. It has to go all the way down to the education system, which in Spain happens to be captured by the public. Well, there is also a capture of labor markets, and there's also a by long-term employees and public employees, and there is a capture of the education system by the public education, which all right. So we're yeah, it's ugly. Okay, this is the ugly part. It is really ugly. Okay, so what can we do? What can we do? So basically, what can we do is we need to reinvent this pay-as-you-go pension system. We really need to completely reform them. We need to redefine our intergenerational pact, and we could start tomorrow. We could tell new entrants into labor market, hey, you guys, this is this new deal. There's a new deal. These are the details. Okay, I can't tell you the details, but we have to do it right now. I mean, if the Italians have done it, I mean, why couldn't we do it? It's going to be a long-term thing. It's going to take 50 years. Yes, we'll have to manage the transition. Thank you, Ellen, for saying transition. Transition is everything in public pension systems. It will be expensive, but we could start to. I mean, we would stop this from snowballing, and which is what it's doing. So this reform should include funding a mandatory or quasi-mandatory funded system, probably organized by the public sector. So there's no reason why the pension agency, why we couldn't have something similar to the premium pension in Sweden. So use some of the 2 percentage points, say, of pension of social security contributions or payroll taxes as mandatory funded individual pension plans, and we could include, using the Dutch scheme, we could start including again mandatory or negotiated or quasi-mandatory or employment plans in collective bargaining agreements and get some coverage there. Of course, the new scheme must create incentives to make Spaniards, to encourage Spaniards to save more for retirement. I mean, and we really need to do that. Of course, this requires that several things. The first one is we have to acknowledge, recognize, convince. I think it was Pablo who said that. I mean, it's our job. It's on us. We have to convince Spaniards that our pension system that's it. It's dead. It cannot be sustained in any circumstance under any feasible reform, and that we need another one. I mean, that we deserve another one. And perhaps also that this requires saving more for retirement. So yes, we really have to do that. But we could also set those incentives properly. And let me just say one. I mean, I'm going to say two things about how my favorite reform, my favorite reinvented Spanish pension system would be. You see, in the last 15 years, 20 years of reforms, nobody has been discussing how do we increase the revenues of the system. I mean, there was at some point in 2012 or 2010, there was this idea, let's lower the payroll taxes and increase the VAT. So that was it was going in the wrong direction, but that was the last discussion I heard, and they gave it some fancy name. This was going to be some magical thing, okay? Which I never saw the numbers, and I never saw the optimal taxation discussion of that. But never mind that. Okay, so how could we do it? Well, the new system, the new pension system, the first thing should be universal. Like me, every single Spaniard, no matter what they do, no matter where they are, no matter what they choose, it doesn't matter. I mean, they pay. If you are self-employed, like, what do I care if you are self-employed? If you are a mutualist or something, what do I care? If you are a civil engineer, why do I care? If you're a lawyer, why do I care? If you're a bullfighter, all these guys have special pension schemes in Spain. Can you believe it? Like disco bouncers have special pension systems in Spain. Resin, the people that collect resin from pine trees have special pension. This is not a joke. It is a joke, but it is true. It's a true joke. Why that? No reason at all. All these special needs that these groups might have could be perfectly addressed in collective bargaining solutions, in funded pensions that are outside this mandatory universal pension system. So 5 million self-employed people in Spain contribute whatever they want to contribute to the Spanish pension system. 1.2 million workers in Spain contribute zero to the public pension system because they have, we call them mutualistas. So these guys have their own private arrangements. Why that? There's no technical reason that why that should be. We have 6.2 million out of 20, let's call it 2018. I mean, the COVID thing will go and everybody will go back to work, by the way. So forget COVID. This is not about COVID. This is way more serious than COVID. I mean, COVID comes, COVID goes, we all die, and that's it. And then some people, not all, some of us die, some of us stay, and then we keep going, okay? So this is not COVID thing. Why? Why 6.2 million people don't pay this, don't pay their dues? It's crazy, okay? But that's how it is. So let's make it universal. Second thing, and I shut up. Second thing, of course, it has to be notional defined contribution. It must be notional defined contribution. If you do that, once you do that, you fix everything. Because now you can make retirement ages completely flexible. Forget about mandatory retirement or incentivize retirement. Make pensions depend on the account, on the balance in your notional defined contribution account. End of the story. Why should you? This is the new generational pact. Okay, so I'm gonna impose automatic adjustment factors on my notional defined contribution pensions, but only on pension rights. Preserve those pensions. I told you to start with. The elderly have captured our system, so we need to reform it in such a way that preserves pensions and puts all the risk and puts all the financing effort on workers. That's how it must be in Spain. Maybe that's how it should be everywhere, but certainly that's how it must be in Spain. Okay, so we're gonna need to do that. And if we don't do that, well, all right. So then everything else that Esther mentioned and that everybody who has seen some numbers, simulated some model knows, this will explode on us. It will remain critical and explosive. It will be divergent and explosive for the next 40 years, and then it will stop. So let's let's just survive, and we're going to be resilient. Okay, so given that now we're all resilient, and then let's be resilient for 40 years, and it takes care of itself. Thank you.
Thank you very much, Javier, for the very bold and crude but also realistic presentation. So we have some minutes left for some discussion. I will take the advantage of having the microphone to put forward a question or an issue. I mean, many of you agree on the idea that we need a holistic and integral approach to the pension system, whatever is the final solution that we give to this important problem. This was mentioned in some of the interventions. Some of you link the education system with the labor market and the pension system, as Javier did 5 minutes ago. Also, Carolin said that at least in Europe, we have to safeguard the labor market as a prerequisite to have a sound and sustainable pension system. I mean, out of the constellation of potential measures that can be put in place, there seems to be one that in principle could do the trick in these two important dimensions, the labor market and the pension system. And especially in a country like Spain that has a very important concern on the sustainability of the public pension system, as Javier and Esther just put forward, but also in terms of the highly inefficient functioning of the labor market, which has many problems. One of them is the extreme duality of temporary workers versus permanent workers. And this system, to the best of my knowledge, is precisely the one that was described in Joao's, Julian's, and Ramon's paper, the so-called Austrian backpack. So my feeling is that in principle, this could do the trick in a country like this one. We at Bank of Spain has been quite vocal in asking for a serious consideration of this possibility. We have also argued at some point that the money coming from the Next Generation EU could be in part used to finance this initial transition. We know that the main obstacle, practical obstacle in many cases with this model is to put the initial money to overcome this transition. But the truth is that this system is a very rare animal in the international sphere. Not many countries have chosen this system, and even in Austria, only a relatively small proportion of workers are actually under this scheme. So my question is for anybody who has a good answer on this, but maybe the co-authors of Joao can say something on this, or Pablo, given your or Carolin, given your unique position in terms of the international overview. Why is it so popular in the paper, but so rare in reality? Thank you.
If I may, I'm happy
sure,
that
Pablo.
you mentioned my name. You say that we all seem to agree that the need of a comprehensive holistic approach, but then you just propose, ask a question about only one approach to introduce backpack, the Austrian backpack. And also you link it to the transition cost. Most of the transition costs come from the fact that most reforms, in particular in Central and Eastern Europe, were made by shifting contributions to the public pensions to private pensions. But the liabilities of the public pensions is still there and will be there for decades to come. So there is always going to be transition costs that are unbearable when you shift contributions from the public system to the private system. So the only way of having very low transition costs is to increase savings above what we have now. But any solution like the Austrian backpack is a good idea. It has, in our opinion, some problems because it's not about retirement, it's about unemployment. So it's not really retirement by definition. It's like a life plan. Well, you save and then at one time you cash the money and you can use it for whatever you want. In this case, you can reach retirement without using it, but some people will use. But basically, it's introducing insurance in a system that doesn't have insurance, so it's good. But it doesn't address all the problem. All the problem is, like Javier says, we need to, and I said before, separate the sources to finance retirement. By itself, it's not going to do anything. I agree with Javier, but it's an important component of the whole picture. Then we need to make the public pension system financially sustainable. And I do agree with NDC. Actually, the proposal we have at the OECD for Spain is the Swedish system. Obviously, you, as Javier said, you can make adjustments to the Swedish system without enrollment. In fact, if compulsion is difficult and everything. All of this can be discussed, but be very aware of the role of employers in all of that, because we have a Spanish system in which you have planes de empleo for a privileged few and the personal plans, and this is big mess as comparison with other countries. And reforming that, if the unions agree to extend the planes de empleo for the entire population, and I agree with the universality of the message of Javier, that is essential, because we also have, and it has to be a comprehensive reform, solving the problems of the pay-as-you-go and promoting and increasing the funded system, but never shifting resources from one to the other, because then you have the transition costs, and the experience of Central and Eastern Europe is, it does not work, you will come back to bring the contributions to the pay-as-you-go, because the deficit will be unbearable. The papers before address the deficit and all of that, I agree, but some of the assumption of some of the discussions said we're too optimistic. In particular, Helen said that assuming no increase in interest rates when you're increasing the debt was a little bit too optimistic. So transition costs are very important, but they come mostly, not all, but there are others, but they come mostly from shifting contribution from the pay-as-you-go to funded systems where the liabilities in the pay-as-you-go stay until everybody has dropped dead. And another thing we say at the OECD, all the reforms from day one should apply to the entire population. And yes, the Italians did the reform. They did it in 1997. They did the Dini, the other 92, 96, 97, to kick in for the entire population by 2037. So they're still waiting a little bit. And I always like to say that they were the ones who introduced NDC, not Sweden, as everybody claimed. Just thank you.
Thank you, Pablo. Maybe someone else wants to react.
Yes, I can.
Ramon.
No, thanks for all the discussion, and unfortunately we do not have a lot of time, but just very quick. I agree with the picture has been put here, also for Javier, except one thing, it's not true that in after this thing happens of the transition, that's it. After the transition, you have a fairly old population, unless suddenly people start having different lives, which is a question to doubt. So a pay-as-you-go system, it's a terrible thing to have in an old population. where you have one person and a half at most for every pensioner, and life expectancy is so. We have to change that. Once you have to change that, then you realize that it's true that politically a lot of times slowly doing reforms seems to do better, but that's a really bad idea. And this has been already said, or Carolin and others, is that when you look at what happens with the transition, you have to accelerate, because this is going to be in all the dimensions, financially, but also politically, they become much worse. So we do have the next generation plan. I think it's great, but nothing has been said about these things. I find it very difficult to, how can you think about the wealth of the next generation without talking about that? Then of course, you might just talking about that, as Javier was saying, others, you have to think about other reforms. I don't see it the way that Pablo, the ICD, see it, that you have to change one system to the other in different formats. That because, for what I said, I mean, you cannot arrive to the end. Yeah, I mean, of course, you can have a Swedish system that the contribution part is large enough that the other is sort of irrelevant, but basically you're amount to doing that. And you have to do it through the transition. Now you can do it different. I mean, the way that Ellen and Prescott had done looking at the state was exactly going into the details of all the loopholes and all the inefficiencies of the financial or the fiscal system to improve, and that's transition. We had been more bold, of course. We understand that when we say that it's a zero grade, but to a large extent, what you're playing here is that the thing in the long run has returns, and it has. That's the reason to, it's one of the best reasons to get in debt. What is terrible is to think that you get in debt because the pension system is broken, because that debt is increasing forever. So that's what it is.
Very good, Ramon. So we are just on time. It's 7 p.m. I mean, it's up to you whether you want to close now or we want to collect any other question there or any reaction by the rest of the panelists.
You are the host at this moment.
Whatever it means being a host in this new reality. I don't know, I would give the chance to any of the other three panelists if you want to say something brief, Carolin, Esther, or Javier, given that Pablo already had this chance.
Okay, so can you hear me?
Sure, yeah.
Okay, so, well, yeah, I must go home, feed my kids because I'm the family cook too. So I don't want to get involved in a big argument with Ramon. Yeah, there is a great advantage about pay-as-you-go pension systems, which is that's the cheapest way to get an annuity and the cheapest way of getting insurance, and that you're never going to beat it. There's not, no matter what you do, okay. And there is also, until we can edit our genome, there is a limit to longevity. I mean, people can, maximum human age is 120. So when everybody lives to 120, that's it. Everybody dies at 121. Okay, so it's going to be like in I forget, in these models that where people die eventually. Okay, so that we die too. Okay, so this can only go on for a certain time. So aging is not a process that is continuous forever. So I think we should and we must have a well-designed, and we can have, and we can afford to have a well-designed pay-as-you-go part of the system. I like the Swedish shares of pay-as-you-go funded and the incentives they create and many of their details. Not all of them, and not all of them are applicable to a place like Spain or Italy, but many of them are. And you must not forget that it's in an environment where everybody ages. There's not an actuarial way to finance increase in life expectancy until we hit that limit, other than pay-as-you-go pension system, which puts the onus on the young and on the machines. Okay, don't forget that either, because so what if everybody can get old as long as we have enough technology, enough algorithms, enough machines as long as to create the necessary productivity, or we can be doing, or we can be working longer years in our life, not because it's mandated, but because we can and we want to do it. So the future will be longer, shorter work weeks, longer working lives, and then that, why not? For many of us in the service sector, that's going to be part of it. So we won't need a full pension if we're still getting some labor income. We will need some when we are 75 or 80 or something like that, and we might want to do that voluntarily. So I would let me say I would definitely preserve I have not been convinced in anything I've seen that we should do without sizable, funded, well organized and well balanced and automatically stabilized pension system. But we should also go to the intergenerational promise cannot ensure longevity entirely. You should ensure pension wealth, not pensions. So pension wealth, yes, you accumulate it through your working lifetime, but if you retire early or if you contribute little, then you're gonna have a miserable end of your life.
Thank you, Javier. Esther just left. So, Carolin, do you want to add something, react to any of the issues that came afterwards?
Yeah, I mean, it was a very interesting discussion and I liked it a lot. I would not dare to give any concrete recommendation with respect to the case of Spain, but I mean, just a general remark that, I mean, first of all, I think pension schemes should be, should reflect that the countries are heterogeneous. So, I mean, there is not one size fits all, and I would maybe also think that it makes sense to have a very diverse pension schemes in terms of not shifting from one system completely to a different one, because I mean all different schemes have pros and cons, and maybe we are not yet aware of all the cons of a fully funded system. So I mean, at least there are also, as pointed out by Pablo, there are certainly also some drawbacks with what we experienced in Central and Eastern Europe. So probably a more balanced approach and not going from one extreme to the other would make sense, and maybe also allow for that this is then also politically feasible, because I mean, an extreme change is maybe also not really realistic in a very short time horizon. So, but yeah, that's from my side. Thank you.
Oscar,
well, thank you very much. Yeah, sure, Pablo, please go ahead. Yeah.
I just want to say something to Ramon, reinforcing Javier. The problem with pay-as-you-go, most of the problem doesn't come from the pay-as-you-go. It comes from the fact that it's defined benefit. It comes from the fact that it's a promise. And that the way a defined benefit promise is defined, there is a complete sharing of the risk from one extreme to the other extreme. I'm not going to go into that because you can have a whole continuum from one extreme to the other one. But the key problem is the defined benefits. And what Javier and I and the Swedes and the Italians and others have done by introducing notional defined contribution in the public system is removing the defined benefit. By removing the defined benefit, basically you are having a system that adjusts the benefit automatically to the parameters of the macroeconomic and the population. And by definition, then most of the problem of the pay-as-you-go disappears. The impact of population aging on a pay-as-you-go comes from the DB, from the promise. That's why it's worse in a pay-as-you-go. But if you go to a Dutch-style system of the old Dutch system up to 10 years ago, that was a promise, they were also with very serious problem. It was fully funded, but it was based on a promise. And the assets did not reflect the materialization of the parameters, and at one point the liabilities were not covered by the assets, and it was funded, but it was not fully funded. And this is the key factor. And the final thing is, some people will argue that I will prefer private pension because I run the private pension unit at the OECD. That's not the point. The point is whether it's politically feasible, and it's not politically feasible to remove a pay-as-you-go system. It is a good system for certain things. We have written a few papers for what is good a pay-as-you-go and for what is good a funded system. And that's why the recommendation of the OECD is to diversify the sources to finance retirement, to have both. But the pay-as-you-go as it is, it cannot be. That I agree with you.
Thank you, Pablo. I think it is time to close. I see there is a lot of appetite to keep discussing on potential solutions to the problem. So I hope that soon we could be in a position to have a second edition of this conference, hopefully here in our premises, so that we can act as proper host that time. In the meantime, let me just say thanks to all the presenters, the panelists, and of course the two discussants, and especially to Ramon for putting together this very, very nice program. So in the meantime, keep safe and thanks very much. Bye-bye.
Thank you, Oscar, and thanks to all of you. Thanks.
Thank you very much. Bye-bye.
Thank you. Bye.